Today we're launching a new study commissioned by the World Gold Council. The study has been prepared by Oxford Economics and looks at the impact of inflation and deflation on the case for gold. The study, I think, is very timely because at the moment we're in a world where we have high inflation pressure coming from Asia in the form of higher commodity prices, food and energy in particular, that is squeezing real incomes in the West at the time of a fragile economic recovery. You're also seeing fears now of deflation or a reduction in growth in Western countries, so investors are unsure whether we are seeing an inflationary future or a disinflationary or deflationary future. And I think this note is very timely in answering some of those questions from an investment perspective.
While gold has been used for centuries to protect individuals' wealth, its recent performance has led to something of a reappraisal of its characteristics as an asset, and also led some to revisit its proper place in an investor's portfolio. The study explores gold's role as a risk management asset. It uses the Oxford Economics global model to examine gold's performance relative to other assets, such as cash, bonds, equities and property, in a variety of inflation scenarios. The report also looks at gold's place in an efficient investment portfolio under different long-run economic conditions. The key findings of the report are that gold performs well in a high inflation scenario and also comparatively well in a deflation scenario derived from a wave of defaults in the peripheral Eurozone countries. And this confirms gold's particular value as a hedge against extreme events. In addition, portfolio analysis finds that due to its lack of correlation with other assets, gold has a useful role to play in stabilising the long-run value of a portfolio, even if a modest negative real annual return is assumed. We find that gold's optimum share of an investor's portfolio in a base long-term case for the UK featuring 2.25% growth and 2% annual inflation is around 5%. This is a higher allocation than seen in typical mainstream portfolios, although the analysis doesn't include other assets, for example, index-linked bonds, foreign securities and other commodities. Gold's optimum share in an efficient portfolio rises in a more inflationary long-run case and also does so for lower risk investors in a long-run case featuring lower inflation and weaker economic growth.
For the first time, we have an independent report that confirms gold's role in a portfolio, both in tactical terms to hedge certain risks around inflation and current scenarios like sovereign default in Europe, but also longer term proves that there's a key role for gold in a portfolio context. The second thing, I think, is that the report shows that current levels of allocations to gold are potentially suboptimal for both institutional investors and private wealth investors, and that indeed most investors do not have the allocation of gold in order to hedge against these tactical risks and to hedge against an uncertain future from inflation to deflation. We hope that investors will enjoy the full report and find it as interesting and insightful as we do.